In this video, we're going to look at Palo Alto Networks, and this is a technology company that focuses on cybersecurity software. What I do in my videos is I run my discounted cash flow model to figure out the actual stock price of the company, because sometimes the stock trades higher or lower than what the company's actually worth. We also look at the financial ratios of the business and compare them to similar companies in the same industry. So let's get started with the model. This company has a market cap of $24 billion. So that's the value of the company according to the stock market. Let's see what they're trading at. They're trading at $248.58. So almost $249 a share. Next, we're going to pull the free cash flows. And free cash flow is the cash that's remaining after operating a business and paying for capital expenditures. So it's important you invest in companies with positive free cash flow, because if you owned a business, wouldn't you want extra cash left over after paying your expenses? Of course you would. Next, we're going to pull the net income, which is a profit or loss according to the income statement. And in each year, they have a net loss. We're going to also pull the revenue, which are the sales for each year, and put that into the model. And the model does all the calculations. As you can see, they have negative net income each year, yet positive free cash flow. So it appears they're passing through a lot of non-cash expenses onto the income statement, which is bringing their net income down, but yet they have positive free cash flow, which is how you value a business. And that's really the most important part of the business, the cash. Let's look at the capital structure of the company to figure out what discount rate we need to apply to the future cash flows. So they pay interest on their debt of $84 million. And let's go to the balance sheet to see how much debt they have. And go to liability section. So no current debt. Long-term debt of $1.4 billion. So the interest on the debt is 6%. And let's get the cost of equity. We need the beta. And the beta is how the stock moves relative to the entire market. So the higher the beta is, the more volatile the stock is. 1.19, so the stock moves a little more than the market, so it's not too volatile. We're going to look at the financial ratios later, so we need some more information from the balance sheet. Let's get their current assets. These are assets which mainly include cash, accounts receivables, and inventory. And that's $3.7 billion. And let's get their current liabilities. These are debts and payables which are due within 12 months. That's $2 billion. And equity is assets minus liabilities. That's $1.6 billion. And let's get their EBIT, earnings before interest and taxes. So they have negative $54.1 million in operating income. And you can see they spent $500 million in research and development. So each year they're spending a pretty good amount in R&D. So that is bringing down their operating income to negative. So hopefully that research pays off in the future. Let's look at their capital structure. So they have 47% debt, and they pay 5.9% on their debt. And they have 53% equity, and they pay 11.5% on their equity. The weighted average cost of capital is a blend of the cost of debt and cost of equity. And the WACC is 8.8%, and that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. We did a terminal value, which is estimation of all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. And the value of the company is $30 billion. We divide that by 97 million shares. And we get a calculated stock price of $315. According to the model, the stock price is worth $315 today, even though it's trading at $249. So it's trading at a 21% discount. Let's see what Simply Wall Street values the company. They're right there with me at $318 a share. So both models indicate there's a lot of future value for this company that will exceed its current stock price. Let's look at the historical stock price. It's been up or down for a while, but it looks like it's almost at its peak at $243. I think there's a lot of room for the stock if you feel this company and this industry has a good future. Let's look at their financial ratios. Negative PE, because they have negative earnings, so we can't look at PE. They have a high price to sales ratio. I like to see under 2.5. They have 8.3. That's price of stock over sales per share. High price to book as well. of 15.1, that's price of stock over book value per share. That means investors are willing to pay $15 for $1 book value. They have a good current ratio. They can cover their current liabilities. Negative ROE because they have negative earnings. Negative interest coverage ratio because they have negative operating income, so they can't cover their interest payments. And they have debt of 47%. The best way to look at ratios is to compare them to similar companies. And I've done videos on Adobe, Microsoft, Oracle, Square, and VMware. And they are all in the same industry as Palo Alto. And if Palo Alto is in red, that means they're worse than the average. If they're in green, they're better than the average. So they have negative PE, so obviously they're worse than the average. They're better than the average in price to sales. They're worse than the average in price to book, but not much worse. The average is 14.2. Their finding current ratio, they're about average. They're much worse in ROE, of course. They're a little worse in debt. Average is 45%. They're 47%. And of course, they're the smallest company because these other companies are massive, like Adobe, Microsoft, and Oracle. So let me know what you think of the video. Do you think this is a good stock with a good future? Thanks for watching.